Okay, so module 2 of the yield curve strategies reading looks at trading a bond portfolio when we have the view that the yield curve is going to change. So we're not saying that the yield curve is going to be static like we said in the last module. We're thinking about what we would do if we expected a change in the level or the shape of the yield curve. Now let's get some big picture foundational concepts in place before we start here. This is fixed income 101 here. When rates go down, prices or values go up. Okay, nothing new there, but that is the foundational concept of how we construct our bond portfolios given a yield curve view. Rather than just saying parallel shift in rates, which is generally what we've said with regards to duration previously, here we're going to talk a bit more about rates at different points, different maturities in the yield curve moving. The general idea is if we think rates are going to go down, we want to go long cash flows that occur at that time because the value of those cash flows is going to go up. Okay, that's the general idea. We do need to have a view on the yield curve that's different to the current market view. So that's why they keep referring here to a divergent rate view, or a divergent view on rates. Your view does need to be different to what's already priced in by the market. That's what's meant by the word divergent here. So some of these trades we know about already. For example, if we expected, with regards to the rate level, if we expected that rates were going to shift down in a parallel fashion, then of course we would increase duration. If our duration goes up, then our price sensitivity increases, and as rates fall, we'll go up by more. So that's something we've already said. I think we said that a couple of readings ago when we were talking about actively trading duration. How would you do that? You'd go overweight longer dated bonds, or you would go long futures contracts, or receive fixed under a swap. So we've said this before as well. Duration is carried by the fixed leg. We met duration when we got into fixed income. So if you want to increase duration, when rates go down, you need to fix your income. You need to receive fixed. Now, be very careful to note here that rates going down is referred to as a bullish view. It's very important, okay? Because of this inverse relationship between rates and prices, when you're bullish on rates, it means you think rates are going to go down, which flows through into higher prices. You're really bullish on prices, aren't you? Okay, so be careful with that. If anyone ever says, I am bullish on rates, what they mean is, or I am bullish on a market, what they mean is they think rates are going to go down and prices are going to rise. Okay. Flip it round. The bearish view is that rates will shift up. If rates shift up, we know that prices are going to go down. So we want to lower our sensitivity to that. We're going to lower our duration. Okay, and take the opposite of what we said above here with regards to changing our portfolio or engaging in derivatives, and you are where you need to be. Now, what about some more interesting views? What about if we thought that the yield curve was going to change shape? So if we had a divergent yield curve slope view, how would we trade that? If you expect a steepening curve, let's just imagine a steepening curve. So no shift around in rates, but our curve starts off like this, and we expect it to steepen. So long rates are going to go up, short rates are going to go down. What would you do there? Well, don't forget the inverse relationship between rates and values. These rates are going up at the long end. So we don't really want to, these rates at the long end are going up. We don't want cash flows there. What we're going to do is we're going to sell bonds there. Okay, values are going to be going down. And they're long duration cash flows as well, by the way. So you want to stay away from that. If values are going down, that means you're going to sell long dated bonds. These rates are falling. That means that values or prices are going up. Okay, and so we're going to go long these bonds here. Okay, and that's what's coming through in our conclusion here. The strategy is to sell those long dated bonds when we think their value is going to fall because long dated rates are rising, and buy the short dated bonds because short dated rates are falling and the values of these bonds are rising. If you didn't expect rates to change overall, maybe you'd take a duration neutral approach. If you expected rates to change overall, Well, we'll talk about that in a moment, but then maybe you'd alter your duration to reflect that view. Notice that with a flattening curve, we've got the opposite situation. It's more about the process that we're going through here, less about the conclusions, the outcomes. It's more about the process. You need to be able to do the process yourself, not learn everything and then go in and recite it, but go into the exam and think, okay, if we've got a flattening curve, long rates are coming down, short rates are going up, right? Because the curve is flattening like this. And if long rates are going down, that means values are going up, so we'll buy those at the long end, okay? And if short rates are rising, that means values are going down, so we'll sell those. So yes, we come to the right conclusion. Buy long-dated bonds, sell short-dated bonds when we expect a flattening curve. It all ties into that basic idea, doesn't it? Rates down, prices up. Yep, it all ties into that foundational idea. Now, what about if we expected the... right, so the slides are going to catch up with us here. A flattener looks like this, and we know what we're going to do. All right, buy those long-dated ones and sell where rates are going up. If you expect a steepener, then you don't buy where rates are going up, you buy where rates are going down, okay? So yes, we did that already. But what about if we expected a flattening or a steepening and we actually expected rates to shift at the same time? Well, this is where we're talking about a bull steepener, for example. A bull steepener means that if you're bullish, rates are going down and the curve is steepening, okay? So if you think about what's happening here, if you try and picture what's happening here, start off with a yield curve like this, and if we've got a bull steepener, rates are falling and the curve is steepening at the same time. So short-dated rates are going to fall by a lot, and longer-dated rates aren't going to fall by as much. Okay, does that look steeper? Let's exaggerate a little bit. There you go. That's a steepener. Short-dated rates fall by a lot. Long-dated rates don't fall by so much. Now, in this environment, falling rates here, that's where rates are falling the most. So that's where we're going to go long. These rates are falling, but not by so much. So we're not going to go long there. It's a relative value trade for the steepening. And then overall, you might sort of say, hang on a minute, all rates are falling. Therefore, we should go net long bonds, essentially. Take a net long duration. And that's true. So really what you're saying is you're going to go overweight short-dated bonds, underweight long-dated bonds. Okay, that's really what you're going to do with this strategy so that you get an overall positive duration. It doesn't have to be that you just purely buy short-dated bonds and short sell long-dated bonds. It's that you're going overweight short-dated bonds and you're going underweight long-dated bonds. Now look, it's almost getting to the stage where you have the rod and you can go and fish. If I told you a bear steepener was in play, you would say, okay, if we start off with a curve like this, bear means rates are going to go up overall, and steepener means we're going to get steeper. So we're going to move to something like this. Rates are going up and we're steepening. Okay. Now we've got these rates at the long end going up a lot, these rates at the short end not going up so much. So we don't like, particularly at the long end, we're not going to get in the way of that. That's going to hurt. But we will. We don't mind rates going up by not so much at the short end. When we think about the steepening, we're going to go overweight shorter term bonds, all right, and underweight longer term bonds. And because we expect rates are rising across the curve, we've actually got a negative duration here. Rates are rising. Overall, we're going to take a negative duration to benefit as rates rise. So we are shorting bonds overall there, shorting duration overall. Now, like I say, it's about the process, not the outcome. If we were in a class, I'd say, now over to you. You tell me what a bull flattener and a bear flattener must look like, and what you would do to trade it. And if you're watching the video, why don't you pause it and try it? Because that's what happens next. Okay? If we have a bull flattener view, the process is bull means we think rates are going down, so bond prices are generally going up. Flattener means that we expect to get flatter at the same time. So if we start off with a yield curve like this, we expect rates to come down and the curve to get flatter. So something like that. And that means long rates are falling a lot, short rates are falling not so much. We like it when rates fall. We're going to go long there. We don't like it when rates don't fall so much. We don't go overweight there. All right, but overall, we are going to take a positive duration because rates are going down. So yes, what have we got? Overweight long-term bonds, underweight short-term bonds with an overall positive duration because we're bullish on rates. That's the outcome. So learn the process, not the outcome. Bear, flattener. All right, so bear means that rates are generally going up. So if we start off like this, rates are generally going up and we're flattening, so we're getting something like this. Short-term rates are rising a lot, long-term rates not so much. And so don't like that, don't like it when rates go up. We do like it when rates don't go up so much. But rates are rising overall, so we're going to take a negative duration. Bearish means we're going to take a negative exposure overall. But we are buying long-term bonds where rates aren't going up so much and shorting short-term bonds where rates are going up a lot, taking a net negative duration. That's how we benefit from that trade. Okay, let's have a look at a numbers example here, see how we get on. This example is called a bull steepening, but we don't introduce the bull nature of the shift in rates until after we've looked at the steepening, just to sort of head off slight confusion with how it's presented here. It does echo how it's presented in the curriculum, so fair enough. But here we've got two bonds, short and longer one, with different coupons, different modified durations and convexities. They do look familiar, don't they? I think we were using those earlier. The manager expects the yield curve to steepen, okay? She wishes to take a long position with a market value of $100 million, pounds, apologies, and an appropriately sized short position. All right, sounds like you might have to calculate that. No expectation of a change in the level of rates for now, all right, but with bull coming in later, we know we expect rates to fall maybe when we think about, we might adjust our position to accommodate a fall in rates part of the way through the analysis. Okay, so we're going to describe the trade the manager should take or make to profit from their view. Calculate the P&L if there's a 20 bips decline in 2-year yields and a 20 bips rise in 10-year yields. Now, if we're playing a steepener, and this happens, at the short end rates go down, the long end rates go up, that's steepening, so that's going to be a profit, isn't it? Big picture. We're going to be happy with that. That's a happy thing. Discuss how the manager would adjust the portfolio positions assuming a bull steepening. Okay, so 1 and 2 are done just under a steepening, expectations of a steepening. Trade 3 is where we think about adjusting the trade to bring in this idea that we're bullish on rates. Okay, so solution here. Describe the trade the manager should take or make to profit from their view. Their view is a steepening curve with no initial change. Feel free to sketch it out and take your time so you don't, tread, so you tread carefully, basically, in the exam. A steepener is where long-term rates are going up, short-term rates are falling, okay? That's what's happening to our rates. We don't like it when rates go up, but we do like it when rates go down. So we're going to go long the shorter-term bond, all right? We're going to buy the shorter-term bond. We're going to sell the longer-term bond, and that's what's coming through here. Sell the long-term bond, buy the shorter-term bond, okay? Because we've got no view on the level of rates, or we don't think it's going to change, we keep our BPV neutral, keep our duration neutral, okay? So do work in BPV terms. Hopefully you're getting used to, as we go through fixed income, you're getting used to working in BPV terms. The BPV of the long position in the 2-year bonds is, you remember how to calculate BPV? Oh, by the way, you were told earlier that the market value of the long position was going to be 100 mil. We need to know that. You multiply through by its modified duration. You can go back and check. The modified duration is 1.86 for the short-dated bond, which we're buying. And that's a basis point, isn't it, which I describe as 1 over 100 squared. That comes out at £18,600. So then you can back out the market value of the short position you need to match that basis point value. Okay, so you want the basis point value of your short position in the 10-year bond. You want that to be the same as what we had for our long position in the 2-year bond. So we know that 18,600 must be the modified duration of the longer dated bond multiplied by 1 basis point multiplied by its market value. That's what we're looking for, the market value of the short position. Okay. So yeah, we can just say, all right, divide both sides by 9.52 times a basis point. This will disappear, and your market value turns out to be 18,600 divided by 0.000952. That's 952 times a basis point. Okay, that comes out at 19,537,815. Sanity check. You kind of take a step back, think, does that make sense? What are we doing? We're taking a 100 mil position, aren't we, in the long, and we're taking only a 20 millish position in the short. Does that make sense? Well, it does, doesn't it? Because the long is only 2-year-ish duration, whereas the short is 10-year-ish duration. There's a factor of 5 difference there in terms of sensitivity, and so you only need 1/5 essentially exposure on the short side to match the exposure on the long side. Once again, process rather than outcome there. All right, focus on the process. The second question we were asked is calculate the total P&L if there is an immediate 20 bips decline in the short rate and 20 bips rise in the longer rate, the 10-year rate. That's great, isn't it? Because that's our view playing out. You won't just correct, you will correct immediately. Long rates went up and short rates went down. All right, you're immediately correct. Now we can use our duration and convexity estimates, our duration and convexity formula to estimate the price change impact of these changes in rates. At the short end, a 20 basis point decline, what we can do is take that 20 basis point decline, multiply it through by the negative of the modified duration of the short dated bond. All right, that's that 1.86 here. And then that's the duration impact. Convexity impact, I'm sure you're getting used to seeing this now. 1/2 of the convexity of the short dated bond, which was stated as 5.2, multiplied by the change in yields at that maturity squared. So that comes out at 0.0037304. If you work in decimal terms, you'll get a decimal out, and that's 0.37304%. You can scale that decimal up by the 100 million position that you've taken to work out the actual sterling impact there. And that's again because you went long those bonds and rates fell. You sold the longer term bonds, all right, with their higher duration. You didn't need as many of them, but when we think about their modified duration multiplied by the rise in yields, so you've got 20 basis point rise in yields at the long end. There's my modified duration multiplied by the change in yield, negative modified duration technically multiplied by the change in yield, plus the convexity adjustment, always positive, the convexity adjustment 1/2 of the convexity of the longer bond multiplied by the change in yield squared. That comes out at minus 0.01883 or negative 1.883%. You can take that and multiply it by your negative market value to get a gain. Don't forget you sold those longer dated bonds, so a fall in price is a good thing. Net gain, add those two numbers up and you're looking at 740,937 gain. Now all of that was just a steepening. Now we now, in the third part of the question, say, what if we expected a bull steepening? Well, bullish in fixed income means prices are rising, so rates are falling overall. If you think rates are falling overall, you should keep a net positive duration, okay? So if you expect a bull steepening, the new thing is bull there, you should keep a net positive duration such that overall your price of your portfolio rises as overall rates fall. So remember what a bull steepening looks like. We start off like this and rates are going to fall overall and the yield curve is going to steepen as well. So that's a bull steepening. All right, short rates fall by more than long rates. We go overweight where rates are falling most and we go underweight where rates aren't falling so much. So what we could do, yes, we're going to buy the short dated bond and we're going to sell the long dated bond, but we're also going to make sure that we end up with a positive overall duration because of the word bull, because we think rates are going down. Okay, so what we could do is, depending on, we've got options here. What we could do is we could increase the long position, or it might be more effective to just short sell less of the 10-year bond because that's where we get most duration pickup. Only short half of the long duration bond or buy twice as much of the 2-year bond, for example, to make sure that we've got positive overall duration. Okay, let's turn our attention now to trading a change in curvature. This, of course, would be a butterfly strategy. We have defined a change in curvature before. We're going to redefine it to really reinforce what a change in curvature means, and then we're going to think about how we trade it and then do an example. So a butterfly strategy, it's all about a change in curvature, all right? If you're playing a change in curvature, you're doing a butterfly strategy. Don't forget that the curvature of the yield curve is assumed to be concave. All right, if curvature is expected to fall, then what we're really saying is we're becoming more of a straight line. Okay, so long rates are going up, short rates are going up. Okay, intermediate rates are falling, relatively speaking. So that's a falling curvature. And if you expect this, you don't want to be in the wings of the butterfly, but you do want to be in the body. So the wings, of course, are a barbell and the body is a bullet. So there you go, there's the trade. Incidentally, if curvature is falling, that is referred to as a positive butterfly. The best way I can remember that is it's positive because you're frowning less. Can you see that? If this concave line becomes a straighter line, you're frowning less. If it carried on, you might even smile. But we don't often see a convex smiley yield curve, right? And incidentally, the butterfly spread, which is essentially two lots of the body minus the wings, two lots of the middle minus the wings, that would fall. So in this example, the butterfly spread would fall, representing a drop in curvature, even though that's referred to as a positive butterfly. You've got to be really careful with that. Of course, the opposite is a negative butterfly where we frown more. So negative people frown more. All right, if we're frowning more, then essentially we start with a curve that's maybe like this, and we frown more. So maybe we get something like this. I'm exaggerating, but the wings there, in terms of rates, are falling, and the body rates are rising. So where do we want to be? We don't want to be here. We want to be here. It's vice versa, isn't it? By the wings, which is a barbell, short the bullet. Curvature is increasing. You are frowning more. Curvature is increasing because you're becoming more curved, and of course the butterfly spread would increase here because the butterfly spread looks at intermediate yields minus the wings, the body minus the wings. So I think the next slide is just really hammering at the summary of what we just did, informally written down more neatly, but it does agree with what we just said. Let's have a look at an example to wrap up this section. So unsurprisingly, with the butterfly spread example, we've got three maturities. It's unsurprising because we're going to need two, a short one and a long one for the wings and an intermediate one for the body. Now, all of the data is right there. You've got a manager here wishing to construct a portfolio to profit from a positive butterfly view. Now, rather than me just say what I've just said again, probably best you think, can you get the process? It's all about the process, isn't it? Not the outcome. You don't learn all these outcomes. You get familiar with the process. All right, so positive butterfly, what does that mean? Yeah, what does it mean? We start off with a frown and we frown less. Yeah, that's the memory trick. Frown less, get more positive. So this means in the wings, rates are going up. We don't want to be anywhere near that. And the body, rates are falling. All right, so what are we going to do? We're going to buy the body, sell the wings here. All right, that's probably the first question here. Yeah, buy the body, sell the wings. It's first part of the question anyway. Buy the body, sell the wings. Yeah, great, we're on the right track. Okay, but we're told the market value of any long position, so that would be buy the body. So we're going to put 100 million into the bullet body, and we want the wings to be of equal market value. Okay, so we're going to sell the 2 and the 20-year names, sell the wings with equal market value. We haven't got a view on rates shifting up and down, so we're going to construct a duration neutral portfolio. The easy thing to do is to get the BPV of the long position in the intermediate name, the bullet, and then solve for what market value we want in the wings, essentially, to make us BPV neutral. So there's a little bit of algebra there, and then we have We'll deal with these a bit after we've constructed the trade. So hopefully we're all okay, visualizing it, visualizing essentially the drop in curvature. All right, so essentially the wings rising, in terms of rates, the wings rising and the intermediate rate falling, and that kind of reinforces that we want to buy the bullet, sell the wings. We know all about that. We want to be duration neutral. We want the BPV of our long body bullet to be equal to the BPV of our short wings or barbell. Okay, it's nice and easy to get the BPV of the long position. We've been doing this a lot now. The long position is in the intermediate name, the 10-year name, and all we need to do is to take the market value we're putting in the long position, which we're told is 100 mil, scale it through by the modified duration of the 10-year name. Looks about right, doesn't it? Just less than 10. And then scale it through by a basis point, which is 1 over 100 squared. So that comes out as 95,200. Not a lot of sweat so far. Maybe a little bit of sweat when we think about what do we do on the short side. The trick is to remember we need to set the BPV of the short side to be equal to the BPV of the long side. Okay, so this is the BPV of the long side. We want that to be the same as the BPV of the short side. And we know that we're putting the same market value in the 2-year, that's the left-hand wing if you like, as we are putting into the 20-year name, the right-hand wing. Because it was a nice thing that the question told us we're putting an equal market value in each wing, because that means we've only got one unknown here, the market value in a single wing. This must be the BPV coming from the 2-year name, all right? And this must be the BPV coming from the 20-year name, okay? And when I say this, I'm talking about all the junk in the brackets. Market value in the 2-year name times the modified duration of the 2-year name times a basis point, plus market value in the 20-year name multiplied by the modified duration of the 20-year name multiplied by a basis point. All of this needs to be the same. All of that is the BPV of the short side, and it needs to be the same as the BPV of the long side. So we can multiply these numbers together. They become small. We can then add up our MVWs, that's the market value in a single wing, generalizing, and we get 95,200 must be 0.001809 times the market value in a single wing. Divide both sides by that small number, and we isolate the market value in a single wing to be this number. Calculate what that is. Turns out to be 52 million and some change. So what we know is the manager should buy 100 million of the 10-year name, that's the body, and they should sell 52 and some change, 52,625,760 of each of the wings. Okay. Now, we constructed the trade, and then we're told that the 2 and 20-year yields rise by 10 bips, okay, and the 10-year yield falls by 25 bips, and that was our trade, wasn't it? We were trading a decrease in curvature, a frowning less, a positive butterfly, however you want to frame it. That was our trade. So we're going to see profits here. And what you can do is go through the duration and convexity adjustment formula for each bond and essentially then apply it to the market value weight that you've taken. This must be the modified duration of the 2-year bond. That's the change in the yield at the 2-year level. It's gone up by 10 bips. That's 10 basis points. Okay, 10 divided by 100 squared, if you like. This is the convexity adjustment. It's always 1/2. It's always positive 1/2 of the convexity. That must be the convexity of the 2-year name multiplied through by the change in the 2-year yield squared. Okay, we've done that a lot now, that duration and convexity adjustment. In decimal terms, it turns out to be this. This is the useful number. It's no surprise to see the bond falling if yields are shifting up. All right, this is the useful number. Scale that up by the negative 52,65750 you've got in that wing, and you get a profit. Yeah, we thought we were going to get profits. Even more profits in the 10-year name when we apply the modified duration to a fall in yields. All right, they're falling by 25 bips, and apply the convexity adjustment. All these numbers are coming from the original table. All right, they're all coming from here essentially. All right, so that's no mystery there. You get a decimalized change here. You can apply that to your 100 mil that you're long, and you're making a healthy 2.4 million in the long intermediate position where rates are falling. So once again, profits. And yeah, profits too in the right-hand wing, the 20-year name, where we have a fall because the 20-year rates went up by 10 bips. All right, we have a fall in the value of the bond, but then we happily remember that we shorted it and two negatives become a positive. So you can add up the 2-year, 10-year and 20-year profits to get a very healthy profit on this trade. Okay, the final thing to do in this question is a little bit more qualitative. Discuss the convexity exposure of the resulting portfolio and the impact on portfolio performance should the manager's view be correct. We saw what happened when the manager's view was correct. So I think a little bit of guidance here in the question, a little bit more guidance in the nature of the question. We can answer it, but you know, the obvious answer with regards to convexity is, what did we do? We went long the body, didn't we? We went long a bullet and we went short a barbell, the wings. Now, it's this thing's going to have higher convexity. It's a comment that really you need to take away from this section. You know, more dispersed cash flows in a barbell, so it's higher convexity. So we're actually, overall, we are selling convexity. So my answer to this question would be, you know, the impact of convexity would be negative, right? You know, if you're long convexity, essentially it has a positive impact, doesn't it? Long convexity means it has a positive impact. It means you go up by more than a straight line, you go down by less than a straight line. However, you're selling convexity here, which is going to have a negative impact as long as the yield changes in the 2 and 10 and 25-year name are the same. Now, 2 and 10 and 20 year, wasn't it? Now, it turned out that it wasn't the same shift. There was only a 10 bips shift up in the wings and a 25 bips shift down in the intermediate name. So what you find here is that the convexity adjustment for your long position is actually bigger than the convexity adjustment on your short positions. So it looks like you're winning from a convexity angle, but that's only because the shift in the intermediate yield is bigger than the shifts in the wings, essentially. Otherwise, the convexity impact would have been negative. I think maybe that was a really nuanced question, and maybe that was kind of like a final mark in a question out of 12 to allow you to really demonstrate you know what you're doing. Showboating marks, you don't need them to pass the exam, but you're allowed to really show you know what you're talking about and get those marks if you can. Okay, that completes module 2 of the yield curve trading reading in fixed income.